Before we dive in, quick shout out to the BDO Retreat. If you're a top producing SBA lender looking to level up your game, connect with like-minded pros, and walk away with fresh strategies that you can actually use, this event is for you. We're talking workshops led by some of the greatest BDOs to ever do it, exclusive networking, and a chance to recharge your batteries after another year of grinding it out. It's happening January 16th and 17th in Key Largo, Florida, and spots are limited. We only have 20 seats. Go to artofsba.com to learn more and reserve your spot today. Now on with the show. This week on the Art of SBA Lending.
I mean, there were government programs where Michael Jackson was getting loans, and that had nothing to do with PPP, right? There are programs where you had dead people getting money,
Sure.
You know? How did a good guy show up in a high quality way? I'm a football fan. This is like losing at home.
Right. These guys are coming in.
own the industry.
Exactly.
We had the best rates, still do. We had the best terms, still do. And now we're starting to have these people come in and eat our lunch.
I once had a boss that told me, if you bring me a problem, you better bring me a solution. Well, the problem is that taking titled vehicles as collateral can be very cumbersome. And the solution is Corpsmart. When you have a loan involving titled vehicles, Corpsmart is there to handle everything, from transferring the registration to taking title to making sure that the sales tax is paid. I've got to be honest, I didn't even realize sales tax was a thing until just a few years ago when my borrower called me from the closing table because he got hit with a $50,000 bill at closing that I didn't account for in my structure. And so in the spirit of solutions, Corpsmart has an offer just for Art of SBA listeners. Now you can quickly and easily request a DMB quote directly from the Corpsmart website so that you can accurately account for all of your closing costs and properly structure your loans up front. Just go to corp-smart.com/Art of SBA. We'll leave a link down below. I've seen you guys, in the SBA space. We're an SBA podcast, so
Sure.
obviously, you have one of the SPLC licenses. Yeah. There used to be only 14, then they printed some, then they printed some more, then I think they got rid of them, but can't even count these days. But like, that's where I started catching wind of what you guys were doing, and you're also a CDFI, is that right?
That's right. Yeah.
So it was like a unique thing, but then you guys like really started to climb the rankings.
Yeah.
How did you become one of the nation's top leading SBA 7A lenders?
Yeah, I think it starts with, at least from my perspective as a leader, it starts with understanding the dynamics of an industry. And then I think our special sauce is we understand the dynamics of other asset classes. So when I came in SBA, roughly in about 2018, first of all, it caught me off guard. It was like taking a gut punch because, no disrespect to anyone, but it was like I went back a couple decades from some of the other asset classes I was used to: consumer lending, residential mortgage.
Oh, I know.
Right.
We take no offense. We know that.
Yeah. So it's just the thought process was, okay, well, first let's try to get our arms around how to do this, which obviously most people would define as an SOP, and then really start to dig in and understand where are the parallels in other industries and how we can think about effectively streamlining, flatlining those things. And to be clear, we're still on that journey. But I think what you're seeing us say, yeah, it's interesting. Residential lending did it this way. Auto lending did it this way. Not really sure if we have to do it the way SBA did it or the current lenders are doing it, but let's at least embrace what they're doing, and then we'll start to tweak and improve as we go along.
Interesting. I do think it takes an outside person sometimes coming in to kind of reimagine what's possible in the space.
Yeah.
And so you guys ended up, I think, cracking the top 10 at one point in 7A, which is really hard to do.
Yeah.
It's a very competitive world, and we do most of us, I think, like operate on the same playbook, which is to hire a bunch of people, hire a bunch of BDOs, hire a bunch of underwriters, closers, process everything manually.
Yeah.
What did you do that was different?
A loan production office, which is hiring a bunch of people, is not new. Many industries went through it. For example, residential lending went through it. And then what you start to realize is that access to the customer can be acquired through other, I would call strategic partnerships, other avenues and different things like that. whether it be you're trying to build your brand. So for example, Lendistry is a partner with the LA Sparks, right? A WNBA team. And Lendistry is a partner with FC Gotham, a women's soccer team. There are other ways to build that brand attraction. And to be clear, you see it. Like you see, if you look at JP Morgan Chase, you see these massive bank branches. I would argue that it's not really a functional bank branch. It's actually a banner. It's a marketing ad, right? Where you're trying to imprint on the customer. So the first thing I would say to you is you start to think about how do you get to that customer. Second thing is you start to think about process, right? And as you start to think about process, what's so interesting to me when I first got into the SBA world is I would have a lot of people say, well, you can't do it any other way. And I'd be like, well, you do realize like that person owns a house and has a car and has credit cards. So clearly the financial industry has figured out a way to give this person credit. Yes, SBA definitely is unique in terms of some of the items it requires. But if we just use something basic like cash flow, somebody else said this cash flow was good enough to give them some type of credit. So how did they do it? And again, we were an outlier when we kind of came in the beginning, started talking like that. And I think now with the advent of AI and more seamless process and things like that, I think it's kind of catching fire that people are like, there are other ways to understand ability to repay or to grab documentation.
Yeah, I mean, it's slow. We tried to resist at first, but I think now you go to conferences, there are sessions on AI.
That's right.
And ChatGPT, I think, was kind of the defining moment of the masses understanding that this is the most disruptive thing to happen since the internet.
Yes.
So now we've got to figure it out.
Yes.
Or you'll be left behind.
Yeah. I mean,
you guys have a head start.
Yeah. And look, if I can show you, I have a leadership slide where it talks about an argument over this brand new technology. Literally, it went to Congress. People were freaking out. Jobs are going to be lost. That technology was the radio, right? And find me somebody who uses a radio right now. And then because I'm a nerd, I started looking up another technology, which was called the typewriter. And like when I was in school, it's like, how many words can you type per minute, right? I don't even think my kids even care about that right now.
We had that,
right? But you know what I mean? Like the typewriter was another piece of technology. One day I'll send this to you. I'll send you some of the stuff on like when people got upset about the car, right? And the horse and buggy drivers like had a strike and all this. So so there's always this version of technology appearing, somewhat of an adversarial reaction to it. And then people start to say, oh, it's not that bad, right? That we can coexist, or this is a better way of doing things. And I think for what we started to do at Lendistry is we really started to understand, one, that the customer was actually going somewhere else. I mean, predatory lending is pretty rampant in commercial lending, arguably more than some other asset classes. And when you start to look at the predatory lending and what I'll just call the bad guys, so to speak, they were meeting the customer where they were at. And so we came in with the thought process, which is part of our mission. How did the good guys show up in a high quality way? Why are we letting them beat us to the customer? Why are we letting the customer feel more warm and fuzzy? Because if you think about it logically, it doesn't make any sense, right? They could charge a higher rate, they could charge a shorter term, and you have to listen to the customer. I mean, I don't care if you go to old school Walmart, Sam Walton saying, look, there's somebody that could fire everybody from the board chair all the way down to the employee, and that's the customer. Or you just use, kind of basic marketing common sense, which is the customer is not necessarily always right, but the customer definitely will give you an indication of how to be right.
Yeah, I mean, it's ease, it's just less friction, and I guess they're willing to pay. Now, in some cases, maybe they don't even realize how much they're paying for it.
Yeah, I think it's astronomical, and we definitely want to keep them from that. And obviously, SBA is making some moves to help support that as well. But I still don't think that gives us a pass for not showing up in a high quality way for the customer.
I love the way you put that. Let me ask you this, because we were talking about this earlier, being like the crux of sort of scaling an SBA division is how do you manage credit quality when you're in a heavy growth mode? Yeah.
So a couple things. I mean, it's funny because when I would first have people come to me and they say I have a magic algorithm or I know how to do this, and I'd be like, Lending's had a magic algorithm for a long time. It's called FICO. Like, don't freak yourself out. Like, there's a lot of people like, oh my gosh, you're doing all this stuff with tech. And I'm like, you've been doing stuff with tech too. Like artificial intelligence. I'll come back to your question. Like if you've ever called your credit card company and they say, type in the last 4 of your social security number, type in your phone number, and then they give you your balance. I mean, who do you think is talking to you? That's artificial intelligence talking to you, and it's been doing that for decades, right?
That's so true.
All right. So, I mean, sometimes I just think we take it a little bit far, but going back to answer your question, you start to go back into historical data because at the end of the day, we're talking about a guarantor and or we're talking about collateral. So both of them, if you separate them, you can actually figure out what is the likelihood that our property will appreciate. Okay. If you know appreciation, you know your LTV, you know your risk of losing money from that property. Same thing with equipment. It does devalue most pieces of equipment. For example, let's just make it simple. A car. Everybody knows the cliche, the moment I drive the car off the lot, I lose money. Well, what do you actually lose? You can actually assess a value with that. And then when it comes to a guarantor, I mean, personal credit has been around for a long time. So separate those things, start to really grab kind of current data. You can buy it from any one of the 3 credit bureaus and you can start building models and things like that. You can actually figure out the probability of somebody being able to pay. And again, going back to what I said before, other asset classes have done this.
It's interesting to hear because what I'm used to is this deal. We had a deal that went bad one time, so we don't do these anymore.
Yeah.
And it's basically decisions made by humans based on anecdotes.
That's right.
That's what banking was kind of built on.
Yeah.
And you're talking about all this data and fancy stuff over here.
Let me give you an anecdote. Last year was the first time in the U.S. no banks were created. Last year was the first time in the U.S. we had under 4,000 banks. If anyone wants to use an industry, if you would look at banking is one of the most failing industries in the U.S.
You're right. I never
now.
thought about it that way. It's a contracting industry.
Yes.
No one likes them. They have a low approval rating.
Yes. Well, I'm not gonna say no one likes that. I got a lot of investors. Don't give me in trouble. Don't give me in trouble. But no, let's put it in perspective though. We were talking about restaurants. People are like, oh no, that's bad. You can't do a startup restaurant. Okay, well, try doing a startup bank in the US right now.
Right.
Right.
So do you think fintech is becoming a bad word, at least in my industry in SBA, because of what happened and everything like that? I feel like fintech, because you guys are fintech, right?
Yeah.
I mean, do you feel like that's a bad word now with some of this community of SBA lenders? Because, I guess mainly because I think the fraud and the PPP stuff.
Yeah, I mean, I think that in every industry there are bad situations. Unfortunately, sometimes there's bad people, and unfortunately, sometimes there's bad circumstances. I think when you look at the pandemic, a lot of things were happening. And if you look at that in a microcosm, you take any type of natural disaster, pandemic, there are a lot of irrational decisions that happen. Do I think that some of those companies could have had better security and systems, KYC, KYB, however we want to call it? Absolutely. I think that there were some that thought they were doing something right. I think there's a lot of commercial lenders that have no idea how bad the bad guys are. I mean, there were government programs where Michael Jackson was getting loans, and that had nothing to do with PPP, right? There are programs where you had dead people getting money, I mean, and that's just, and that, again, this is outside of PPP, and I won't name the institutions, but they were, arguably some of the most secure institutions in the United States that this money was passing through. And so why do I share all that? Because I want to be careful that we don't take isolated incidents. The definition of fintech is finance and technology coming together, with finance being first. The way we think about it is if you put finance first and you have all the characteristics of a good financial company, and then you leverage technology to enable your experience, that is kind of the American dream, right? I mean, show me somebody who doesn't have a cell phone. Show me somebody whose, car doesn't talk to them or doesn't have Bluetooth these days. So the absence of technology is a mistake in anything that we do today.
I mean, there's like this fintech group over here, and then there's like the SBA traditional industry here.
Yeah.
And this group wants to like innovate, but they don't really understand SBA. And this group understands SBA, but they don't want to innovate. Like, what's that disconnect there? Like, what can bring those two things together? Because they have to kind of meet in the middle to actually meet where the entrepreneur is at.
Yeah. I mean, to me, it first starts with what's your mission and what's your purpose? My mission and my purpose is to help as many small businesses as possible. If you put that first, then everything else should be secondary. I think that there's some people that put, how they feel, possibly their ego, all these different thoughts first, but it's not the small business. You should not necessarily call yourself a small business lender and say you work for small businesses and not do what's best for them. That being said, to answer your question, I think what happens is you take baby steps. You crawl, walk, run. And if you take that process of crawl, walk, run, like anything, I mean, insert the language that you learned in, elementary school or high school or college. Just take the baby steps, right? And as you take those baby steps, you will start to get better. I think fear is one of the big things as well. But again, look, I don't know anybody that came out the womb running. I know people that fell, bumped their head, might even hit a table, right? I know people that when they rode their bike, they fell off the bike. They might have had training wheels. Training wheels came off. Technology is just the same. It's a foreign language. There's no doubt about it. But I think we have to take it slowly and embrace it. But again, that mission and that thought process has to be first, which is I'm going to help small businesses.
Yeah.
If you've been a fan of the show for a while, then you know one of my favorite companies to work with is Rapid Business Plans. Last year alone, their business plans helped facilitate over $600 million in government guaranteed lending. They're on track to beat that this year. More and more small business lenders and their borrowers are relying on Rapid to help with the business plan, projections, and assumptions because their team goes the extra mile to ensure everything is done fast and done right. And that helps streamline the process. They're great at export business plans, by the way, which are critically important at protecting that 90% guarantee. Rapid also offers feasibility studies, which tells you if the project is, well, feasible. I would recommend these for any large startup loan because it protects you and it protects the borrower and helps you get more good deals done. Go to rapidbusinessplans.com to set up your Get Acquainted call today. Find out why so many top producing BDOs recommend Rapid to their small business borrowers. We're going to leave a link in the show notes just for our Art of SBA listeners. Now let's get back to the show.
And you guys do a lot of the smaller loans too in the space, right? And so how has the SOP change impacted you guys to where now basically what's considered a small loan has been reduced to from 500 to 350? Does that mean you're going to make less loans in the 350 to 500 space?
Yeah, I don't think so. I think what'll probably happen is other lenders will probably make less loans and we'll see a surge in applications. That's what I just think is highly likely. I think
I mean, I'm less inclined to do it.
I mean, and that's okay, right? I think those of us that have technology and continue to embrace technology will get better faster. I'm going to give you an example. The Guinness World Record for the person who can do a Rubik's Cube can do it in 3.13 seconds. There was a group of scientists out of Purdue University that built a computer program to do the Rubik's Cube in 0.03 seconds. So, my conversation is very simple. Do you want 100x or do you want 10x? Because I'm on the plan for 100x, right? I think to answer your question, the SOP definitely made some changes and definitely there's more documents to collect. We had to do 100% of the ownership versus, only having the 20% owners. Right. Little things like that definitely cause some more complexity. But I would argue that technology can help solve and, you can email that application to those other owners faster than you could probably get them to sit down with you and fill out, an application or PFS and some other things. Yeah. So I think what'll happen is, the technology players like ourselves might have a little bit of a slower start as we kind of get our process together. But I think what you'll ultimately see, just by sheer numbers, if you now had to fill out an application that has 2 people versus 1, 4 people versus 2, you're going to see technology will win. And again, I'm saying that because look at Rocket Mortgage versus what it did with some of the other mortgage companies or Loan Depot. I mean, the technology will ultimately win because it's more user friendly.
Yeah. No, I loved getting a Rocket loan a few years. My mind was blown. I was like, whoa, why can't we do this?
Yeah. Well, you can.
What about the MCA stuff where like we can't refinance that anymore? Is that impacting your business?
No, I mean, well, yes, I think it impacts all our business because unfortunately there are
we were all doing those loans.
Yeah, well, there's small businesses that are getting those loans, unfortunately. And again, that goes back to my kind of like, how did a good guy show up in a high quality way? Because the way I tend to think about it is, I'm a football fan. This is like losing at home, right? I mean,
These guys are coming
we own the industry.
Exactly.
We had the best rates, still do. We had the best terms, still do. And now we're starting to have these people come in and eat our lunch. So what are we going to do about it? Like, I hate losing at home when I play football. Like, it was like, it's like the worst thing ever, right? And so I actually have a lot of passion towards it. That being said, I do understand what the SBA is doing. I think, we're talking about taxpayer capital at risk. I don't think that the SBA should pay off those loans because I think that adds to a higher IRR to those MCA companies, and therefore they might use that extra capital to do more marketing and do other things.
Take.
So my perspective is different. Now, do I hope there's a little bit more balance? I do think that there are people who unfortunately get an MCA accidentally. I think there are a lot of consumers who just need cash and they don't always read documents, and that for them not to have that access could be unfortunate. So there's probably a healthy balance somewhere between not at all, maybe having one or maybe having two. But I totally understand that we have to think about how we add more capital. Other asset classes will call it refinancing. We have to think about how we add more capital because, the rules say unlimited loans to 5 million. It doesn't say one loan to 5 million. And I think there's a lot of opportunity for our SBA lending shops to, again, protect home turf and think about, why does a customer get refinanced? From a customer perspective, it is, I want a better rate. I want a better term. From a lender perspective, it is, I want to protect my book and not lose a good customer.
I mean, I think one of the concerns from the SBA is that we will clean up the mess of the balance sheet by refinancing them all, and then they'll go out and get more.
Absolutely. That's a real risk.
100%. So, I mean, one potential solve could be that they have to sign something that says they won't.
Yeah.
Agree to it in writing.
Yeah, I think that's right. And then again, just going back, I think we also have to make a decision consciously that we would do a better job of marketing to our customers and saying, hey, if you need more capital, come to us first.
We're terrible at marketing.
We'll go back to your Rocket Mortgage. I bet you've got a ton of emails from them.
100%. I mean,
absolutely.
Dude, it's crazy. We don't do the basics as an industry.
That's right.
We're not doing the basics. I mean,
and that's what's interesting to me when I study other asset classes, right? I mean, you get a consumer loan, insert the name, Lending Club, Prosper, SoFi, whatever. You're constantly being marketed. Do you need something else? Do you need this? They even give you suggestions. Do you want to take a vacation? Do you want to pay off a credit card? Do you need to pay a student loan? They start giving you suggestions just so that they're planting that seed. Again, I'm a newcomer to the industry, 10 years or less, depending on, kind of how you look at it. And having been in lending for almost 3 decades now, really, really surprising when I came into the industry to see that, kind of the disconnect.
Yeah, and it's such an incredible tool, and I feel like it's like all the small business owners really want an SBA loan.
Yes,
that's
absolutely
the best.
Holy grail.
And we are the ones that have it. We're the delivery mechanism for this amazing product.
That's right.
And yet we don't tell anyone. And we, stopped innovating in 1999. And I'm being like super general and kind of painting with a broad brush, but it's getting the point across that let's wake up here, guys. We're at this point. People are doing it. We have to all step up our game and kind of rise to the challenge.
And it also depends on what you care about. Again, small business is like my heart, my mission, our company's mission. And you really do have to decide, are you going to show up in a high quality way to meet the mission, right? And I think it is not, you get the added benefit that it is a good living. You get the added benefit that you're helping, communities and different things like that. But if you truly want to be a lending all-star, part of it is you got to sit there and say, how can I change the game a little bit?
Right. Shake it up.
Yeah.
Try different things.
That's right.
Let me ask you this. Now, Lendistry has grown.
Yeah.
You look back, what are some of those pivotal moments or kind of strategic decisions that you made that helped you scale?
One of the first thing that comes to mind is during the pandemic, we made a decision to help out. I mean, we were like everybody else. We thought it was, hey, let's go home for a week or two. We'd get a little bit of a break. But we decided to roll up our sleeves. And just, Lendistry has a couple different channel partners. One are banks, one are government agencies. And being there for them really helped us to scale. I mean, we're known for our PPP volume. We were number 8 in the country. We took about 200,000 units. But what might not be known is we did a program for California where we took 344,000 applications in 15 days.
Oh, wow.
So I tell people all the time, PPP was great, but we actually have some other, we could show you some other stats. I mean, fortunately, unfortunately, we had to help out with LA wildfires. We took 9,000 applications in a week. So we we've had the opportunity to step in and again kind of show up in that high quality way, and that's really what's helped us to scale, and then we're able to use some of those scenarios as kind of like an R&D when we go back to kind of traditional lending and say, that's interesting. I'll give you an example. We have built an electronic signature for 8821 where we can grab the tax return from the IRS.
Well, that's interesting.
And so, but the technology was something we built because you're in a fire, you lose all of your documents. How are you going to be able to, how?
I think that's going to blow people's minds.
Yeah, well, we're coming. But,
that's the only blue ink signature we need in the whole application.
That's right. So, but when you start to think about stuff like that, what has happened for us is because we are involved in other capital deployment exercises, we get an opportunity to innovate,
right,
and then test it.
Yeah. No, that's awesome. I think I'm going to switch gears for a second because since I have someone who is a CDFI on the couch,
sure,
I want to learn more about that because I'm genuinely interested because I don't know that much. Does that designation mean like you have this sort of mandate to help underserved communities?
Yeah. Becoming a CDFI, Community Development Financial Institution, a little bit of history, created in 1994 because Treasury realized that banks couldn't do everything. And what they essentially said is we're going to build an extension to a bank without the same regulatory, we'll call it process, no depository, although a bank can now become a CDFI. That wasn't the initial plan. But we realized that there were these underserved, and the definition of underserved, just the things that the banks weren't covering. And we're gonna effectively unleash this to, again, be a partner to the bank. So that's why they get the automatic CRA credits and all the other things that go along with it from a regulatory standpoint. But it was really Treasury just creating another institution. And no different than when SBA created the SBLC, right? Back in the day, the SBLCs were larger group than what the banks were, right? Because they were trying to think how the agency was trying to think how it could distribute loans. When you become a CDFI, they do make you effectively approve, this is at the board level, and then carry out a mission. And so generally that mission is related to lending capital. There's really three types. You could be a VC investor. You could be a loan fund. So VC fund, a loan fund, or you could lend CDFI to CDFI. We were a group of community bankers. And so it just made sense. It was a natural fit for us.
To be loan fund type.
To be a loan fund.
So why are those underserved communities underserved? Because a lot of the banks I know are greedy and would love to make a buck off anyone.
Yeah.
And then how do you go after those markets?
Yeah. I mean, I'll give you my technical answer. So when I was at Wells Fargo, we had something called correspondent banking. And the job of a correspondent bank, a big bank, is to support smaller banks. And let me give you some numbers. So there were 10,000 banks. There were roughly $1 billion in assets and below. I felt that as a large institution, and obviously it wasn't my decision, but we basically recognized that those smaller banks had more access to the community than we did. They were in the community, the person walked into the bank branch, they knew them. Why not lend to the bank that had a loan size maximum, or maybe just didn't want to take the risk, traditional syndication participation loan, because we would still get access, right? So we were getting capital deployed, leveraging that small bank. Fast forward to today, there are 1,000 banks that are $1 billion assets and below in the US. So it's that 90% loss that has really caused the problem. And then let's take it another step forward. Let's say you're one of the survivors. Average community bank 10 years ago was $800 million. Average community bank today is roughly $4 billion. So as you know, when you have these deposits are a liability. What does someone do traditionally? They start moving up the size of their deals because there's only so many hours in a day. There's the operational expense associated with it, or said differently, economies of scale. And so naturally you start doing larger deals because you have more assets, which are really deposits, which are really liabilities. So I think kind of that factor of losing 90% of those banks by size, the banks that survived got really, really large. Same thing's happening right now in the insurance industry. Same thing's happening right now in the private credit industry. And what you're just naturally having is, you know, financial organizations doing larger and larger and larger loans. So now go back to your question. Well, if they're doing larger loans, who's doing the smaller loans?
Right.
20 years ago, 30 years ago, we would say to people, have good credit, have good income, you get a loan. No one said, hey, by the way, it must be at this loan size, right? So you got an 800 credit score, you got an amazing debt service ratio, you walk into the bank and it doesn't even do your loan size. There's no sign on the door.
Minimum loans.
Yeah, there's no sign on the door that says, hey, we don't do this loan size.
Yeah.
Right?
Right.
But the truth is they don't do it. And I'm not saying like literally they don't do it, but I'm saying that's not their specialty. Or, there's only so many hours in a day. They can only focus on, higher cost, middle market or something like that.
And I think technologies has been and will continue to be a huge solve for that problem.
Absolutely.
But I want to really kind of stay in this small loan conversation for a while, because I feel like that's the biggest thing. Like from just a pure, how many, like I think more businesses need $50,000 to grow their business or start their business than, $5 million to acquire a business.
Yeah.
So this is really the conversation that we don't have here.
Yeah.
And so with that business owner in mind who wants $50,000 to, let's say, start a business.
Yeah.
How much does education, just basic financial education, play into this? Because those are the business owners just starting out.
Yep.
They may not even, maybe we say, I don't think you should get a loan, but they think they need a loan to do something. But what's the big challenge there in that small loan space?
Yeah. So first, we don't do loans that haven't been in business for 2 years.
So why is that?
Well, because we expect there to be a certain amount of sophistication in the business owner, and we assume, sometimes right, sometimes wrong, that once that business has gotten to a certain level in its history, it's went through some of the growing pains. Now, to be clear, we have partners to do it, and then they generally refer to us, right? Because they'll do the smaller loan size. That being said, we have a lot of mature businesses that ask for small loan sizes.
Sure.
A ton of them. I'm a sales guy at heart, so I think about it like a pyramid. At the bottom of the pyramid are the small businesses that are going to file bankruptcy. They're probably hobbyists or something like that. Really don't have it. At the top of the pyramid is where most of the banks and the private credit are going right now. Like, let me do a deal with 50 million and a bit of 100 million and a bit of, one of my friends the other day was like, I'm doing 200 million and a bit of. That's the top of the pyramid. Like, that's a real small group. The fat is in the middle, right? So if you could service that middle, which happens to be growing because a lot of people keep increasing their assets, that's where the real opportunity is. And then going back to, the thought process that SBA does not say one loan of 5 million. It says unlimited loans of 5 million. It's really about understanding the dynamics of that borrower. Let's go back to technology. When you insert yourself into a bank account, not only do you get to see the revenue, the seasonality, you could really understand before the borrower understands when they need access to capital, right? Because all of a sudden, a significant amount of income is coming in. Okay, well, guess what? That means they're growing, right? They probably need to hire people. They probably need to think about their operations a little bit differently. Their HRS system, their treasury system, their accounting software. Let's say it's going down a little bit. To your point about education, education doesn't have to be sitting in front of anybody. I mean, most universities in the U.S. have online education now. So why can't we offer
all the answers right at your fingertips?
Exactly. You see the business going down, virtually send them an education class that lasts for, 10 to 20 minutes. That says, this is how you do your business. We have 40 different online classes. I mean, we don't have to see you face to face, but technology can let you know exactly when you deliver that to a business owner. And if we're really, really being honest about the business owner, the data shows that the business owner isn't even available during normal hours. Why? Because they're running their business.
We were just talking about that earlier with one of the software guys I had on the pod.
Yeah.
He said the prime time is 10:30 on a Friday night.
Yeah. So the way I always describe it is she's running her business from 9 to 5, taking care of her family from 5 to 9. When do you think she's online applying or having the time to educate herself?
Exactly. So, at some point, the SBA, SBA is a mission-driven agency.
Absolutely.
Job creation program with the 7A. For a while, the focus was on minority-owned businesses, veteran-owned businesses, women-owned businesses.
Mm-hmm.
Now the focus is on Doge, but anyway, I digress.
Yeah.
But when you focus on minority-owned businesses, women-owned businesses, and they talk about a gap in funding there,
Sure.
I'm always curious at the root cause of that gap, because to me, they can go online and apply for a loan, and I don't think they're getting denied because they are minorities, but there seems to be a disconnect there.
Yeah.
So where is the disconnect?
Well, I mean, I think, and I mean, we obviously take loans from everybody, but when you have an opportunity to talk to different business owners, and I think women-owned businesses and rural-owned businesses probably fit into the same category as well. I think what you see is a lack of education, and I'm not talking book smart education. There is a community rapport that builds inside of every business industry. And what you have is you have one business owner talking to another business owner. And so what I think we're seeing that those business owners aren't talking to another one, but that's because the first one didn't get a loan. And because the first one didn't get a loan, they didn't tell their brother how to get a loan, or their sister how to get a loan, or their cousin how to get a loan. And then what happens is you start to see exponential growth inside of that community. And an example of that is PPP. PPP is the first time that I know of in commercial lending where there was a consistent application process, where there was a consistent, these are the documents you need. And I would argue that PPP wasn't that easy in terms of payroll and different things like that, but there was consistency. Guess where else there's consistency? In residential lending.
Right.
No matter what state you're in, the first 5 pages are the exact same. No matter what lender you are, no matter who you are. Guess what else there's consistency? In a student loan, right? In an auto loan.
Yeah.
It's just very interesting to me. And credit card. It's just so interesting to me that all of these other asset classes do the exact same thing. And for some reason, there's been a decision not to do the same thing, even though we have statistical proof with PPP that if the application process was the exact same, you would see massive amount of flow. I mean, there's a reason why residential lending does $1 trillion a year, because everybody goes through the same process. So now let's go back. He buys a house, she buys a house, she goes and tells her friend, all you got to do is fill out these same 5 pages. Guess what? I got a copy of mine here. Let me share it with you. And guess what that person does? Oh, what? I just got to put my name in here, and I just got to put my employment in here, and it's going to look the exact same, no matter what part of the country you're in, no matter what dollar amount you apply for, no matter what type of house you get.
Oh yeah, and it's so different today. I mean, you can like if somebody wants a business loan from me, I mean, people are like texting me. And
right,
they'll call me, they'll email me, they'll do anything, whatever.
Yeah, and again, what's crazy to me is sometimes I'll talk to people and they're like, well, no, we have so many products. I'm like, the average residential lender has 600 products, but they keep it really simple. You know what they do in residential lending? They ask you the same question. Is it your primary, secondary, or investment? And then everything else is a filter from there.
Right.
And I think sometimes in commercial lending, we should probably think. Maybe we do use of proceeds.
Exactly. That's what I was going to say.
And use of proceeds could be the filter.
Makes perfect sense. But it's so crazy because it's like the BDO model is what is prominent in our industry.
Sure.
So and the BDOs get no training. Most of us want to just hire existing BDOs that have been trained by other institutions to come in. So even within your own institution, you can have 10 BDOs doing it 10 different ways.
Yeah.
And they're just like, we just ask whatever questions we feel like asking that we think are relevant.
That's right.
And get as much as possible, and then go to our credit manager and say, hey, I got a deal.
Right.
Here's what it is. And he asked a question, and I'm like, I didn't ask that. Okay. I guess I got to go get that question answered.
Yeah.
And you're just running around, and then the next deal comes in and it's a different dollar amount. So you got to talk to a different credit officer, and he has different questions.
Yeah. But you see my shirt here says Lendistry University. So roughly 2 years ago, created an internal university inside of Lendistry. And I had to go back. And read the books by Jack Welch, for when GE started their university. Because to your point, I was like, I don't understand. There's a lack of education. There's this assumption that the last person taught this salesperson correctly. The foundational training is relatively non-existent. Don't get me wrong, Nagel's got some good training, and there's some other kind of random one-offs. But again, comparing it to other asset classes, lots more training, and I don't understand it fully, because I think on one hand, there was a decision to not have training to be defensive, almost like protect the industry, not let everybody in, but completely missed the offensive. Like, we're not going to score any points. Like, you know what I mean? Like I kind of got it, but the offensive is way more of an opportunity than the defensive, because unlike other asset classes, it's hard to get into SBA lending, right? You can't just walk into a bank and be like, I'm going to start an SBA shop. I mean, how many banks have tried that and it doesn't go well? You definitely can't be a non-bank lender because there's a moat because of the licenses.
Well, it's crazy with here's the problem with our industry and why there's not a lot of banks that can do SBA. It's because like there's this promise of the guarantee, especially now in the era of Doge. The SBA, of course, when the focus is on the P&L right now, cutting, all of that, the subsidy, bringing the fees back, and it's like, no, you didn't do this right. You missed this here.
Yeah.
Maybe it didn't have anything to do with why the business defaulted, but technically we gotcha.
Yeah.
So we're not going to honor that guarantee.
Yeah.
That bank then gets out of SBA. I even heard a story the other day, like a bank bought another bank who had the buying bank got burned on SBA. So like, they're like, all right, we got a deal to buy your bank, but like, you've got to shut down the SBA department as like a contingency of this deal because we had this bad experience. And so that all starts spreading because of that little dynamic.
Yeah. Yeah. I mean, what's hard for me, because I am a nerd, is I tend to think of a lot of the stuff as a math problem. And again, being a nerd, I go back and look at history. I mean, there was a point where HUD was undercapitalized in terms of the guarantee program. They did something which I think would really help any agency. I don't think it's specific to SBA. They basically increased the guarantee fee, and then they used data to make a decision about what was riskier and what was less risky. So it's called mortgage insurance premium, MIP. But they're basically different types or different levels of mortgage insurance premium in the HUD loan. So some people pay 2%, some people pay 2.25%, some people pay 3%. I honestly hate this oversimplify it, but I think certain things like this are basically a math problem. What's beautiful about SBA is SBA has the data. So, take a guy like me, let me get in there. I'll run an algorithm, do it really quickly. There'll be some people that get charged 5%, 4%, 2%. Dude, I don't know.
Did I give you the questions beforehand? Did you? I literally have in here as sort of a creative idea of doing. I said, do you think SBA should use more of a risk-based fee model?
I didn't see that.
So that lenders can take on more risk, but when more goes bad, there's more subsidy to take care.
Well, let's be clear. Amazing. Let's be clear. Guarantee is an insurance product.
Exactly.
Insurance, you don't have to go far to figure out how insurance works, right? You're in a certain, zip code, geography, you get in too many accidents and your insurance will adjust.
They're the kings of data.
Good or bad, right? And then as a buyer, you make a conscious decision to maybe, move or buy a different car. If you buy a red sports car, your insurance
we all know that.
Everybody knows that, right? So, I mean, I think there's a version of that, to answer your question, that could be applied to small business, and then give yourself time to get it right or wrong, right? And I think, again, the industry has to say, this is our problem. Let us provide a suggestion to fix it. Obviously, the agency has to sign off on it. I mean, we sell, for the most part, against predatory lenders. The average interest rate on a good day is 40%. So there's a lot of room there for the guarantee fee to increase. And look, it's going to be painful, and there will be the occasional borrower that doesn't like it. But at the end, but where are they going?
That's so true. That's so true. It's like, that's the big opportunity that no one is talking about, is we have all of these borrowers here willing to pay a lot of money to get loans faster, which we know will default higher if we underwrite less. And maybe you disagree or agree with that, but like, I think we basically as an industry said, like, we're not ready to do score and go $500,000 loans. Sure. And so that said, that's what these MCAs are. They're very quick money out the door, but you're paying all this, interest rate basically for it. If the guarantee fee was just higher, it could offset Like we could do it in a way
Right.
where the taxpayer will be made whole.
Right. Well, the problem, the issue with the MCA lender is they do not have an insurance product. So they have no choice but to increase the rate to try to outrun default rates.
Yeah.
We have an insurance product.
Right.
A guarantee is a way to socialize the risk across every single borrower. That is insurance at the end of the day. You're hedging, right? And you're absolutely right. I mean, at some point we should sit down and say, it's just a math equation, guys. Right? I mean, and let's be clear, the majority of people are paying on time. So anytime you have the majority of things going right, your insurance product actually works. You just need to get the numbers to match whatever the expectation is.
I think this is an area we really need to focus in on, because the guarantee fee formula, which you're familiar with it, 2%, 3%, 3.5% based on a couple loans.
Sure.
I can almost assure you that no data was put into creating that.
Yeah. Well, I mean, you probably know better than me because you've been around longer than me. But the second thing I'll also say is the industry can also do what the residential industry did and say create its own. That's what private mortgage insurance is.
Well, that's an interesting idea that we've thought about as well.
There's nothing wrong with saying putting money in a pot, and socializing it. I don't think we're quite there at the size yet, but there is definitely a size where, again, as a nerd, I know that I'm going to run that mathematical equation and definitely going to think about it. I mean, SBA allows the small dollar to do, 0.5%. But I think there's something to be said. And there's state guarantee programs that have been around since the 60s that we participate in, and they do it. So, there is a version of this that is already persistent in the U.S. in lending, inside of the asset class and outside. And I think, there's people much smarter than me that could run some of these models and help figure it out.
It's just interesting that there is such an appetite to pay more money for faster capital and no sort of response or action on our side to even think about how to make that work. Like if we can charge 20%, it's a win. If we can get the money out the door in 3 days.
That's right.
Because it's just fascinating that there's such a large gap between where we're at now, 10, 12%, and 40 to 180%.
That's exactly right. And that's what I mean by home turf, right? At some point, the good guys have to sit down and just say, look, we cannot lose at home. Right. And I think that's really, really important.
Well, I think we'll leave it there. I appreciate you coming on. That was fascinating.
Thanks, Ray.
Really enjoyed
Appreciate
it.
the time.
All right, that's it for this week's episode. If you want more SBA content, you can sign up for our monthly newsletter and check out our sister shows, SBA Today and the BDO Show. We'll leave a link in the show notes. And don't forget to subscribe to this podcast so you never miss an episode of the Art of SBA Lending. Ta-ta.